Good day. My name is Omri Thomas, the Portfolio Manager of the Nedgroup Investments Opportunity Fund. Thank you for joining us today. The heading of today's presentation is topped out. And by that, we mean we've seen inflation rolling over, we've seen global interest rates starting to roll over. Is this the top of the rate cycle? And what are the implications for the economy? So if we just look at what's happened to inflation rates from very elevated levels, we can see that there's been a synchronized decrease in inflation. It's still above the long-term range that central banks want to have it in, but we can see it's getting a lot closer. It's becoming a lot more sticky. So the easy part's been done. Now, we've seen bond yields. Bond yields didn't really believe the high inflation numbers fully. You can see that didn't run up as much as inflation did. And we have seen bond yields pulling back slightly. So a bit of capital gains made from holding global bonds, but still very sticky and still relatively high. If you look at it, global real yields, despite inflation coming down substantially, only one of the four major developed markets having a positive real yield. So not protecting you against inflation risk should there be an inflation blowout. If we look at the valuation of the S&P relative to its long run history, so what's the real yield one can earn from the S&P? It's still also a negative or slightly positive real yield, and it's below its 30-year average. But we've seen as inflation has come down that there's been a narrowing. So the valuation not that extreme if you compare it to inflation or interest rates. So and why do we compare it to inflation or interest rates? Because that's the cost of capital that the companies incur, and that cost of capital now slightly lower than where it was a year or a year and a half ago. If we look at South Africa, our prime rate, as we know, 11.75%. The market's currently pricing in somewhere between 75 and 100 basis points price cuts over the next 24 months. So not really a massive reprieve coming from inflation coming down. If we look at our long bonds versus US long bonds, where US long bonds was an uninvestable asset class because there was just no yield, one can see the clear narrowing in yields. So we've been adding to our US bond exposure as we're currently seeing sort of a positive real yield coming from the US and a nice diversifier. And it is the global risk-free asset class. If we look at opportunities performance over the last year, I'd say disappointing. We underperformed inflation +5 and our category average. The reason for that is after a fantastic 2022, we were quite concerned about the macro outlook, and we took a lot of a risk off the portfolio. That looked okay till the fourth quarter of last year, where we saw a strong rally in risk assets. So we were too conservatively and too early in that positioning. We still think the macro risks are out there, and if you look at the long run return for the fund relative to benchmark, inflation +5, and our peers, we're still very happy with the alpha added over the long term. And since inception, we've actually managed to achieve that inflation +5 target, which is a very tough one. Now, where we are now, if we look at what the starting yield is for the portfolio yield at close to 8%. So that provides a nice floor to your return. So we're quite optimistic about returns for the next year. If you look at what caused that, what contributed to performance, what detracted, what's clear from our contributors was that the global tech shares that we owned, both Alphabet as an individual name and also through Abex Global Equity, contributed handsomely to returns. And then two of our top 5 contributors were actually South African government bonds. On the detractor side, you'll see 2 auto calls that detracted. Now remember, these are investment notes with a 5-year time horizon. There's some capital protection built into it, and we've got another 3.5 year on average duration on those. So despite detracting from performance over last year, we are quite optimistic about the risk return prospects from this point in time. To take BAT as an example, the auto call basket is trading at maybe 80 cents in the rand. Should BAT stay here, we're gonna get our capital back. So you're gonna see a return from 80 to 100 over the next 3.5 years on average. But should there be some price recovery, you also catch up on all the coupons that you've missed out on. So we think it's a very attractive asymmetric return potential coming from there. Sasol, one that I must admit that we we've gotten wrong quite a few times in history. If you see Sasol in my top 10, please tell me to sell it next time. No, I'm joking. At current levels, Sasol trading at a 4 times PE. They're probably going to earn somewhere between 50 and 60 rand a share. At the current level, a 4 to 5 PE, a very attractive dividend yield. With all this global macro uncertainty, we think there's potential support for the oil price, and because of demand supply fundamentals, we also think that the oil market could actually go into deficit, which should support Sasol. In addition, the chemical side of the business historically has earned between 50 to 60% of their profits. That's very depressed now, and it's earning only 10% of their profits. So if you do see some recovery in that side of the market, that will be further support to the business. So just looking at the outlook for the rest of the year, as I said, we think inflation's rolling over, but it's sticky and it remains above average. Global rate cuts are being priced in. We think the tight US labour market could keep pressure on inflation. The Nasdaq and S&P is close to new highs, but yet the volatility index, which is the price that you pay for protection, is at a very low level. So adding protection to a portfolio is not the worst idea currently, and you won't pay too much for that. We've seen Chinese stocks under tremendous pressure, and that's been a bit of a hunting ground for us in the last 3 to 6 months. We've added to our Chinese exposure. We are cognizant of the fact the risks associated with it. So you do temper the amount of shares that you own and the weighting within a fund, but we think there's a substantial return potential from the Chinese markets. In the meantime, we've got high cash rates locally and globally, so you can run a conservatively positioned portfolio and still earn a very decent return. And that is the way Opportunity is positioned at this point in time. And I'll show you the asset allocation in a few slides. We do expect rate cuts to come through, which is very necessary for our economy. Our economy is under pressure, and the businesses felt the impact of high rates, of load shedding, and that will offer some reprieve to that. So on the back of that, we also see some value in select SA equities. We've been adding to our bank exposure, and we also think bonds, despite the recent rally, do continue to offer attractive real returns. So just our outlook on the asset classes, starting on the expensive side, we think US equities continue to look expensive, especially the sort of magnificent 7, if we can call it that. I mean, that drove most of the returns on the S&P last year. Developed market bonds, ex the US, still look expensive. US bonds have moved from the expensive bucket into the fair bucket. And as I said, we've added to that exposure. Developed market equities outside the US also looking attractive. We think the rand is sort of in a fair value range, probably slightly undervalued, but with fundamental reasons for it being there. And in global cash, also fair. We think SA bonds, SA equities, SA cash, and emerging market equities looking attractive. So having a higher local exposure, again, that is where we see the value. And we've actually seen a lot of capital flow out of South Africa because of the relaxation of Reg 28. But remember, it's not a one-way bet always. We've seen in the last 10, 15 years, 3 periods of rand strength. So in the past, that sort of 25, 30% foreign asset limit wasn't seen as a limit, it was seen as a target. But now at 45%, it's an active asset allocation decision that one has to take. And we do take it seriously also in opportunity, where we have reduced our foreign exposure, our FX exposure slightly, despite our foreign assets being higher. And that is through currency hedging that we've done. Just looking at the asset allocation, and I've contrasted it against where we were in July 2023, you'll see the major change is the increase in SA bonds. As I said, we continue to see value there, but we've also shifted within that, added inflation linkers and some of the shorter duration assets where you get a nice yield pickup. And the other increase that you'll see is offshore bonds, and that's been financed from mostly from cash. SA equities, very similar level, and you'll see offshore equities also slightly higher, but with our FX exposure slightly lower because of our currency hedges. Our top 10 equity positions, you'll see that Absa has moved into the first position. We think it's very attractively priced. It's got a nice dividend supporting the valuation. And we've also switched some of Standard Bank and FirstRand into Absa as those two shares outperformed Absa. British American Tobacco, we think is very cheap at this point in time. They are in the phase of transitioning to next generation products, and because of that, the market's been concerned and the valuation has been under pressure. They generate over £10 billion of cash. They're probably going to reduce their debt, and we expect maybe them to start resuming share buybacks towards the end of 2024 or first half of 2025. And that could also provide some support for the share. In the meantime, you've got a dividend yield of almost 10% in pounds, and if you strip out their holding in ITC, it's trading at below a 5 times price earnings ratio. I've spoken about the Chinese shares. You'll see Auto Home, which is the Chinese we buy cars. You'll see Momo and Alibaba, 3 Chinese tech shares currently in our top 10. And a new entrant is TBC Bank, an up-and-coming bank in Georgia, very similar to the likes of a Capitec, growing tremendously over the last couple of years. They've just entered Uzbekistan as well. And you're getting it at 4 to 5p in an economy that's growing at 6% per annum with a dividend yield of over 6%. So attractive asset to own. And you'll also see Naspers Process back into the top 10. And that's after the big sell-off that we saw in December. We used that opportunity to introduce Naspers and Process back into the portfolio. So just a final slide to show you how cheap British American Tobacco is and why it's now our second biggest holding. On the right-hand side, if I start there, they own 30% of the India Tobacco Company. And just that valuation, market cap. So if you strip that out on the left-hand side, that is what you pay for the rest. You can see it's just over 4 PE. So we think at current levels, on a risk-adjusted return basis, very attractive entry level into British American Tobacco with the support of a strong dividend yield. And with that, I thank you for your support and look forward to see you in the near future.